Understanding capital budgeting, cash flows, and payback period. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our email and our phone number. And a good source for some PowerPoints is the publishing company McGraw-Hill Irwin, which was the source for some of this content. We had talked in our first capital budgeting video about discounting cash flows, and I want to use an example of the Levi's sewing machine. Let's assume that you're the manager of the Levi's plant and you're going to buy a sewing machine to use in your business to operate more profitably. So if you look at the top of the page here, we have a cost of $10,000. Because we're operating more efficiently, we're sewing jeans faster and being more profitable, we're going to assume that we're going to have a cash inflow each year of $2,000. And we're going to use the machine over 6 years, so it's going to produce $2,000 a year for 6 years. And we'll assume our inflation rate, and we defined inflation in the first video, is 5%. Now later on we're going to talk about an acceptable rate of return, but for now we're going to refer to it as the inflation rate. So here's an analysis of what's happening. You can see we have year 0 going all the way out to year 6. Our cash inflows and outflows, and some other information I'll get to in a minute. So in year 0, we're writing a check for $10,000. And in years 1 through 6, we're getting $2,000 in the door. As we defined inflation in the first video, number 1, that dollars in the future do not have the same value in dollars today. So we need to discount or adjust for that 5% annual inflation rate. So that the $2,000 received in year 1, when we use the present value table, is $1,904. The dollars we receive in year 6 are only worth $1,492 today. So if we adjust and put everything in today's dollars, we're paying out $10,000. And if we add up all the inflows and assume it's in today's dollars because we're adjusting using the present value tables, the present value of the inflows and the outflows is $152. And since it's positive, we would make the purchase. Now we take other factors into consideration we'll talk about later. But strictly from a cash flow analysis, since it has a present cash flow, apples to apples comparison in today's dollars, we would go ahead and make the purchase. But there's another factor called payback period, the second bullet point here. And the questions you should ask yourself is, what will the benefit be in dollars? How profitable is this decision I'm going to make? But the other question is, how long is it till I get my cash back? The textbook definition of payback period is the amount of time the company must wait before recouping its original investment. There's good news and bad news. The reward is you may have a project that would give you a very high rate of return. But the risk is that cash that you're using for the project is going to be tied up and you can't use it for other needs like paying employees, buying inventory, buying supplies, and expanding your business in other ways. So there's a risk and a reward. If you go back to the Excel document, we show our formula for payback period, which is the amount of the original investment divided by the annual cash flows. Our original investment here at the top was $10,000. That's the numerator in this problem. Our cash flows years 1 through 6 are $2,000. Now you'll notice something interesting. We're going to get back our original $10,000 at the end of 5 years. And if you look at the note here, our cash is returned, but in today's dollars, we're not yet profitable. And here's what I mean. If we add up the present value of the $10,000 we pay out in year 1 and the present value of the payments in years 1 through 5, you'll see that the present value of those flows is actually negative. So although we get our cash back in 5 years, if we adjust the inflows and outflows to today's dollars, it's actually negative. So these are two different decision criteria. And what the owner of Levi's needs to consider is, although you're getting your money back in 5 years, it's not going to be profitable for you until the end of the 6th year. So there's a disconnect between getting your cash back and the project being profitable. That's the end of part 2. You'll see part 3 on YouTube, continuing the spreadsheet. Our YouTube channel, Ken Boyd STL, all one word. There's a complete list of our videos on our website. That's the third bullet point, stltest.net. We do live tutoring and chat sessions using GoToMeeting.com. Here's our email address and our phone number, and we'll see you next time.